Automation is about to replace some jobs and create whole new industries that could double portfolios. I'll show you 3 practical automation investment plays and the exact metric I use to avoid costly hype. No fluff. Action you can take today. I'm John Hok from AmosFinance. This is episode 3 in our Future Investment Trends series. If you want investing that survives disruption, subscribe and tap the bell now. In the next 6 minutes, you'll get a clear map of automation trends, 3 buckets to invest in, a buy-avoid checklist, and ready-to-use sizing rules for your portfolio. This isn't sci-fi, it's ROI. Automation is moving from factories into office workflows, logistics, healthcare, and even white-collar roles. Businesses are investing to cut labor costs, reduce errors, and scale faster. That creates long runways for companies that provide the tools, from chips and sensors to robots and software. The trick is, some of these winners will be durable cash machines. Others will be hype. Today, we'll focus on how to find the durable winners. 5 categories matter for investors: semiconductors and AI hardware, chips that power automation, industrial robots and integrators, the physical machines and installers, logistics and warehouse automation, conveyors, sorters, AGVs, automation software and RPA, robotic process automation, code that replaces repetitive office tasks, sensors, edge devices, and IIoT, the data layer connecting machines. Each has a different risk-reward profile. Hardware is capital-intensive, software is scalable. Our job is to balance them in a portfolio. Think in buckets. That's how you manage risk and capture upside. Use 3 buckets to structure exposure. Bucket A, infrastructure and semiconductors, plays that enable automation, chips, data centers. Bucket B, robotics and industrial automation, the physical builders and integrators. Bucket C, automation software and services, SAS, RPA vendors, managed services, and reskilling platforms. Each bucket has a role. A gives leverage to macro adoption, B captures real-world deployment, C offers recurring revenue and margins. If AI and automation run, chips and data centers win. Bucket A is where you buy the rails of automation, GPUs, FPGAs, AI accelerators, and the cloud and edge data centers that host them. These companies benefit from secular capex and multi-year contracts, but they are cyclical. Orders spike and then normalize. What I look for: order backlog and capacity expansion plans, long visible demand matters, gross margins and pricing power. Hardware can be margin squeezable, prefer firms with diversified product lines. Supply chain resilience. Does the company own key fabs, partners, or is it single-sourced? 1 concrete metric to avoid hype. Prefer hardware names where the current EV trailing 12-month revenue is 6x unless revenue growth 40%. If growth is slower and EV sales is super high, you're buying story, not cash flows. Practical buy tips. Use a staged entry. Buy 25% at market, 25% on pullback, 8%, and hold remainder for confirmed order growth. Consider ETFs for diversified exposure to capex cycles. Robots move stuff, and logistics is where money follows movement. Bucket B includes robot makers, automation integrators, and companies that retrofit warehouses. These businesses show the translation from project wins to recurring service revenue. Important signs of quality: backlog duration, 6+ months is healthy. Installed base plus service revenue, aftermarket services raise margins and stabilize cash flow. Diversity of end markets, auto plus logistics plus pharma, is better than single end market exposure. Red flag: firms with high one-off project revenue and low recurring service. Those can be feast or famine. Practical play. Look for integrators with a growing service recurring revenue line and robot OEMs with proprietary controls. That's where margins widen over time. If you like predictability, software is your place. Bucket C is the software layer. RPA vendors, industrial software, MS, SCADA, cloud automation platforms, and training reskilling platforms. These businesses usually have high gross margins and subscription models. Key metrics to prioritize: ARR growth, annual recurring revenue. Consistent double-digit ARR growth matters. Gross margins, 60%, and net revenue retention, NRR, 100%. Signs of product stickiness and upsell. Customer concentration. Avoid names where one customer is 15% of revenue. Practical examples of exposure. Combine direct stock picks in established SaaS automation names with a small allocation to fast-growing RPA pure plays. For conservative investors, use high-quality software ETFs or a managed account. Don't be blinded by shiny robots. Here are the red flags. Watch for excessive valuation versus growth. Hardware firms with sky-high multiples and modest order visibility. Customer concentration. One big contract can disappear. High capex without service attachment. Capital-heavy models risk margin compression. Supply chain single sourcing. Choke points kill timelines. Regulatory labor backlash. Governments may slow certain automation deployments or impose taxes, subsidies, affecting returns. Quick rule. If a company's story depends on more than 3x projected growth to justify today's price, pause. Wait for earnings visibility. How much should you actually invest? For a balanced investor, consider 40% bucket A, infrastructure semis, 30% bucket B, robots integrators, 30% bucket C, software services. Conservative investors tilt more to software and large-cap semis, aggressive investors upweight hardware and integrators. Keep position sizes between 3–7% of portfolio per single stock. Use ETFs for broader exposure. Always maintain a 5–10% cash buffer to buy on pullbacks. Automation will reshape work, and your portfolio should reflect that. Buy durable rails. A. Capture deployment. B. And own recurring software. C. Use the checklists I gave you, size positions sensibly, and don't confuse hype with cash flow. Next episode, we'll rank the top 5 automation stocks I'd buy for 3 investor types: conservative, growth, and income. You don't want to miss which one I'd buy on a dip. Hit subscribe and tap the so you're first when that drops. Drop a comment. Which automation bucket do you like most? I read them all.